here we go. Perfect. Well, we're live on YouTube, we're live on Facebook. Both cameras are over in that direction, in case you're wondering. I'm here today with Ron Stroup of loanDepot. Ron and I started doing an MSA together, doing a lot of marketing together. But one of the things I noticed with working with Ron is he knew a lot about home loans, different ways to finance deals, and one thing that I know gets agents more deals than ever, and the main goal for today is understanding the idea of creative financing, not just in the way that sometimes we hear about talked on the internet, but in a way of being creative with financing in general, to look at all the different options that are out there to try to help get our buyers more ability to actually purchase property. So without further ado, Ron, thanks for joining me today.
Yeah, thanks for having me in. I'm excited with our MSA partnership, and appreciate you guys having me.
Awesome. Well, let's get right into the thick of it. Today, guys, we're going to talk about seller finance and conventional FHA. We're going to talk a little bit 203K, 5-to-1 ARM, getting a bit about rehab, some construction loans, hard money, ultimately chattel finance and seller finance. And the point it would be, like I said, it's really for you guys, it's the understanding of when I understand more loan products, I can get more deals. It's one of the things I learned right away. Actually, funny story, Ron. When I first started in real estate working with different agents, one of the agents said to me, like, oh, the person got denied, it's just a loan. And I'm like, well, what do you mean they got denied? And they're like, oh, they got denied. And I'm like, yes, but you understand that like different banks and different loan products and different things fit different people, right? And they're like, honestly, no. Because they just thought of the word mortgage, right? This is just what the average person thinks of, right? They think of, okay, if I can't get a mortgage per se, if I went into, say, any large bank or institutional lender and suddenly got denied, they don't even realize that there's different options out there. So
Yeah.
I think that's what's so important about today. Obviously, guys like Pace Morby, all these other guys, all talking about creative finance, and typically they're talking seller finance. So we'll start out the gate. I'll talk a little tiny bit about seller finance. One of the most interesting things of seller finance is the idea of you really don't actually have to have a credit score. You don't actually have to have college education. You don't have to have money. You have to have a person, or two people really, yourself and the other person, willing to meet and set what they call terms, which at the end of the day, there are terms involved in every loan.
Yep.
So it's the same thing. You just got to find terms that work for both of you. So sometimes for situations, especially cash flowing properties and things that maybe not everyone was honest with Uncle Sam, because let's be honest, not everyone likes to pay taxes. So we find these situations where we find maybe a cash cow per se, but the bank doesn't see it that way, and it's because it's not on anybody's Schedule C, it's not on any provable income. So this leaves the seller like wanting the most money for their property but not able to get it. So that's oftentimes where we find sellers, distressed property, can't make their payments, they maybe didn't pay their taxes, things like that. That's where seller finance comes in. But typically, when dealing with home purchases, we deal with a lot of the other options. So why don't we jump into a little bit about conventional?
So actually, I have a couple of questions for you on the seller
Sure.
finance side. So I don't usually see that. Most loan programs, conventional government loan programs, allow for a portion to be seller financed and still get a mortgage for the first mortgage. As long as they meet the down payment requirements, the seller can hold back a note as long as we see what the terms and conditions are and they qualify to carry both. So I've done a few of those in my career, but your seller financing is more so identifying a seller, a buyer that doesn't necessarily fit into that box with conventional financing, and then basically they just work out the terms and conditions without having to be approved for a mortgage.
Yeah, now there's a whole mix of in between, which is why, the word creative financing really.
Right.
But there's a whole mix in between of what you can do. 100% to the seller, or like you said, there could be a certain percentage to the bank and a certain
Sure.
percentage to the seller. So the ideas are really limitless, and that's one of the most important parts of creative financing is thinking about things out of the box and how can we get this deal done to make everyone happy. Because a lot of times the people who are most willing to work with seller financing want more money than their property is worth.
Right. Sure.
In some people's minds.
Yep.
But the person who sees it right, they see the ability to make money there, they're willing to buy it. Maybe they say, well, the seller's going to give me a 2.5% finance rate right now. Well, it's 8% right now. So even if I pay them more money, my payments over the 30, I'm not looking at the same, and I'm not a fix and flipper. I'm in a long-term hold, I'm gonna rent this out, or I'm gonna live here.
Yeah.
You know, so depending on the person's situation, or really both people's situation, any mix of it can really come together.
Do you usually see some type of balloon finance within that? I know the terms and conditions are going to vary across the board.
Typically, with true seller finance, a lot of times, now there are, I mean, like I was watching a video last night, the person bought a large-scale multifamily on a 50-year note through seller finance.
Right.
The person wanted to make filthy money, they both were happy, could do it, right? But typically, most of the time, whether they tell you or not, the people that are out there, the investors, they want the financing gone.
Right.
So usually they're going to want to put into the terms no payment penalty, and they're going to make a balloon.
Right.
A lot of the deals I've done, especially the ones recently, usually 10 or 15 year payout. And what it does is it takes it from those guys, and then it's easy to finance because now your debt to income, or not your debt to income, but your how much you owe on the property versus how much the property worth is now upside right as far as the bank's concerned.
Right.
Now the appraisal will hit. Now we're not on speculative value, and then we move into the next thing.
And then at some point, those buyers, once they do start paying taxes or fitting into the conventional or government mortgage box, can then refinance out of it, and then the seller gets their full amount, and they're getting more money because of the terms that they negotiated up front.
Right. So, situationally, I think everybody that's a seller wants to get paid all their money and leave, right? It is nice to make the extra interest. Sometimes capital gains are involved, things like that. So offsetting them and putting them in payments versus, one lump sum allows you to, fan the money out a little bit. So a lot of different options and alternatives with why people do it. But seller financing, huge opportunity. Typically, I wouldn't say for like a first-time home buyer, things like that. Not saying they can't do it, but it usually isn't within their wheelhouse of what they're willing to do. And, it really depends on the marketplace. A lot more seller financing exists when people are distressed or trying to get more money. So with the current marketplace right now, you go to someone, I'll give you seller finance, and you probably would need to offer them your firstborn child along with everything else, the no inspection, all this stuff, and then maybe they say, okay, but not everyone can do seller financing either. It's important to understand that, obviously as a seller, you actually have to have a way, a means to either have a second mortgage and have that person paying you and almost like a rent or some sort of situation.
Would you put rent to own under that seller finance category? I would assume, right?
Yeah.
Have you had any experience with that?
I've had lots of questions about it, but I'm yet to meet a seller that wanted to do a rent own.
I've had the same. Never done it.
It's a lot to ask, and even right of use, right? Like a lot of times we sell a property, the person wants to move in before the closing, or the person wants to stay after the closing, and they're gonna get some sort of right of use, even do work on the property ahead of time, and everybody's freaked out. The insurance company, the owner, because not everyone acts like you, right? Do they take their shoes off when they go inside? Do they, drag furniture around versus pick it up? Do they decide to paint walls? Why? I don't know. People do some weird things. So
exactly right.
Even somebody in a house is opening yourself up to problems sometimes. So that's, with a seller financing, obviously you usually give yourself the recourse so that you can actually foreclose on the property. So it is possible as a seller to kick someone out, but it's usually something that the seller doesn't want to deal with. And depending on their financial wherewithal, it could actually end up in a situation, because to get someone and to take over the property and to repossess the property, foreclose on the property is not cheap.
Big process to do it.
Cheap.
It's definitely not cheap. There's a lot of legal, hoops to jump through with that. The big banks, they can afford to have that on their books. They don't want to, but they can afford to have it on their books. But an independent seller who doesn't have a lot of cash, they could end up in a lot of trouble. From a realtor perspective, I know, buyers that you help with seller financing, it's because they probably can't get conventional type of financing. So I understand that part of it, but from a seller side, is it just digging into your network and identifying people who might be interested in that, or how do you identify potential sellers that would be open to seller financing?
Typically, they've been sitting on the market a long time.
Okay.
You can go into public record and look at who's about to get called on a mortgage, who's missing their payments, look at pre-foreclosure.
Okay.
Pre-foreclosure, obviously going down to the courthouse, to the registry of deeds is a great place to start. Looking for distressed property, businesses or companies, or not companies or businesses, yeah, they're businesses or commercial properties that may have sat on the market for a long time. Because you'll notice in commercial, it's not uncommon, like basically the everything's for sale method, right?
Yeah.
Like literally a sign's up there forever. When you call on the price, they're like, yeah, I want 1.7. You're like, 1.7 for that? And they're like, well, if you pay me that, then you can have it. So some of those sellers, you know, I knew one actually recently that offered some of the businesses we were leasing in there the right to actually basically do a lease to own, but to do seller financing and to buy it. And he was really wanting a lot of money for it and very little friction.
Yep.
So that was kind of what he was faced with. And seller financing, when you bank finance certain things, there's certain reports that are needed. You might need a 21E on a commercial property. You might have a dirty 21E and they just want to transfer it anyhow. There's all sorts of reasons people do it, but why don't we jump in and talk a little bit about conventional?
Yeah, that commercial stuff goes so far over my head. I've never been involved in commercial, so it's interesting to hear. So conventional. So I think most lenders today are selling loans to Fannie Mae, Freddie Mac, FHA, or Ginnie Mae for FHA VA loans, or state housing programs, or USDA for the rural programs. So it's hard to get creative because we all have to follow the same guidelines. But every lender has a little bit of a different overlay to those guidelines. It could be credit score, it could be loan to value, it could be reserves, it could be any number of things. And that varies from lender to lender. I think more so when it comes to conventional and government type of loans, where we see being creative is understanding the guidelines and how to use them to get creative. The one thing I never like to do is say no to people that, looking at it right away, they don't qualify, but more so like, how do we make this work to qualify? So that's when it comes to experience with, knowing the guidelines or having, and I don't know all the guidelines, they've changed so much over the past 25 years and I always have to lean on my underwriting department. But I think it's a matter of, really digging into it and talking to underwriters, like what can we do to make this work a little bit better? And I'll give you two perfect examples that happened this year with two of your agents. VA borrower, he got turned down from another lender on a pre-approval. I looked at his overall profile and, there was a little bit of work that needed to be done on the credit side, but he had access to, even though VA is 0 down, he had access to put 5% down. And just by simply putting that out there to him, like, hey, if you put a little bit of money down, ran it through, we got an approval done, and we were able to get him closed. So it's, it's little things like that, I think, where we get more creative on the lending side.
Yeah. Well, what about like I always, people that come in and they, oh, I have an FHA loan. The creativity of like when to use the FHA versus the conventional.
Yep.
Like, sometimes a buyer comes out and they have an FHA loan and they're looking and say in an intense market like right now, it's hard to get an offer accepted. Now you throw an FHA loan on top of hard to get an offer accepted. Sometimes the creativity might be to just show them that this person could get a conventional loan.
Yeah,
or
absolutely.
same with that VA, like they, like you might be nervous about this, and if it doesn't work out, we still want the house. We're willing to work with you through these other terms.
Yeah, absolutely. And that's a good point. Like a lot of people who do qualify for VA or FHA, and maybe it's their credit score. With VA, it's cut and dry. Like it's the best program on the market. But a lot of veterans do have money to put down, so they're able to get conventional financing. But it might not make sense for them. The rate and PMI might be higher on the conventional loan versus a VA loan. So what I do is I pre-approve them for both. And then that way I can show a listing agent, hey, they're qualified for a conventional loan, but they just want to take advantage of the benefit that they've earned.
Yeah.
Similar to FHA, sometimes credit scores on a conventional and PMI might be higher, or lower credit scores might push the PMI up and the rate up on a conventional, whereas on FHA it doesn't matter as much. So the better deal might be FHA, but they can go conventional, and we'll show them that as well.
Yeah, so one of the things that's so important about this episode is just the idea of thinking outside the box to get more deals done.
Yeah.
Because that's really what we were talking about when we talked about creative finance, and the idea of creative financing is, as a real estate agent, I always tell my agents in training, I say, if you think about yourself like a carpenter or something, like you have your tool belt and like you're general mortgage word is like your tool belt, and all the little ones you hang off there, like your conventional, your FHA,
Right.
your 203, your 5-to-1, your rehab, your chattel loan. The more of those you understand when you're talking to someone in public and they say, I wanted to buy a mobile home, but unfortunately they don't accept FHA loans. You'd say, well, yes, that's because it's chattel, which is personal property, and here are some great chattel lenders. And
Yeah.
you should talk with these people, and then suddenly, okay, now the deal can happen. Without the knowledge of the different types of, finance there is, then as an agent, you're kind of dead in the water. You think, okay, back to that original story, right? Like the idea of like, okay, well, my people were denied a loan,
Yep.
denied a mortgage. Okay, well, why don't we take a look at another angle and be a little more creative? So one of the ones that's been good to me, I don't know if you're running a lot of them, but is the 203K.
Yeah, great program. Yeah. Just the basic FHA loan credit requirements are identical for the most part. Income and credit qualifying, asset qualifying is exactly the same, but someone's able to roll in the cost of renovations or additions, repairs, whatever it might be, and still finance with 3.5% down. So you just take the purchase price or whatever that purchase price is. They get estimates, and a HUD consultant to basically say, here's what needs to be done to meet FHA requirements. You can roll that cost in as long as it appraises out. And with FHA, it's actually a little bit better than some of the other rehab programs because you can borrow up to 110% of the value of the property. So it doesn't necessarily have to appraise out exactly at what the purchase price and cost of repairs is. They've got a little bit of wiggle room there.
Interesting.
So it's a great program. You can do a lot of different projects with it. So yeah, if someone's, housing inventory, what's that look like today?
Yeah, no, it's been that way, believe it or not, for years, really. Locally,
Yeah. Oh, yeah.
And nationally, everyone has different experiences, but locally, I can remember doing one. We're in Marshfield, and people on Marshfield, and for those of you not local to there, it's in not a low end community, not a high end community, but it's really surging and it's getting expensive pretty
Sure.
quickly.
Yeah.
Surrounded by really, really high end communities, my opinion, one of the best value towns for the South Shore that we have. They wanted in, but their budget was not for that area. But what we were able to find was a house that was seasonal.
Yeah.
And we were able to put a heating system in, which is what got it approved for a loan. And because a lot of other agents didn't have creativity,
Yeah.
no
absolutely.
one saw it as a year-round home. So these people put insulation in, put a heating system in, got it passed as a regular loan, walked in with equity, and now I would say they're the better part of $200,000 in just living equity, not for just the idea of the appreciating market, year-round house from winter. And all it was a simple 203K idea. I said, guys, this house isn't going to look like what you wanted.
Yeah.
But give me a chance. Let's go look at it. Because it's a risky one as an agent. You're like, I got a house. Well, that's nothing like I want. Like, I know.
Yeah, exactly.
I know, but we got ideas.
But with a little bit of vision, you get a price and you get a place in a good community at a great price, and you're able to put some, elbow grease into it. You're right. If you're a realtor or a lender that isn't willing to at least explore those programs, I think you're going to pigeonhole your clients and really not do them a really good service.
Yeah, and for those people that must get a deal, I have clients that don't matter where the market is. They're not willing to pay full price or over full price for anything.
Yep.
So we're certainly in the current market locally. We're not looking at stuff under 60 days or whatever if they want to get a deal. We certainly can try, and I never offend anyone. I say, let's write it on paper, let's submit it. You're putting your best foot forward. But for those people that like it, the 203K or any of the other rehab products really can give you the advantage on the back end of like, okay, this has been on for 180, 320 days because it needs so many different things. Now we can get a deal and you can get sweat equity through the work that's being done because, one of the nice parts about getting to do a renovation loan is you're improving your own home. It might be a new kitchen, might be a new bathroom, so you're walking into a better home than you would maybe be able to at the same budget if you bought it done. So
and the other program that's great is the VA renovation loan. They can finance 100% of it. So if the property doesn't fit the veteran, and there are a lot of disabled veterans out there, and they can make specially adapted housing, so it's a more accessible property for them to live in, and you can borrow 100%. So guys, that's just again one more opportunity to find more deals. So
why don't we jump into the 5-to-1 arms?
I haven't done a 5-1 arm in probably about 5 years.
Yeah, it seems like
So-
right now no one's going to be touching those with the interest rates, right?
No, so lenders just don't want to get involved with 5-1 arms, so the prices are actually, the rates and prices to get into an adjustable rate mortgage just makes 0 sense right now. You can get a better deal on a 30-year fixed, a 15-year fixed, because lenders understand that at some point rates are going to drop. And they don't want to have all these 5-1, 7-1, 10-1 arms out there that they have to, that basically are refinancing off of their books. So 5-1 arms are great. They're in the right market for the right client. Anytime I counseled someone in the past on 5-1 arms, or any type of arm for that matter, it all depends on like how long they think they might stay in the property, or are they going to see something, improve in their financial situation in terms of, if it's something where, they know that they're going to be getting a raise in the next few years. They just want the lower payment right now, and then, refinance out of it down the road when they're ready to get into a 30-year fixed. Or if they just don't think they're going to stay in the property for that long.
Yeah, those ones are the risky one. If you know what
Yeah.
you're doing with them, you can play with them, but they are risky in the idea of that. So let's jump into like construction loans. I think that's one big confusion, right? I meet, Zillow, we buy lots of Zillow. It's a great company, fun to work with. You meet people that all walks of life, all different ideas.
Yep.
But they know nothing about real estate yet, typically. So they come in and they're like, I'd like to look at this house. And you're like, that house won't even qualify for like any financing, never mind, not even just FHA or VA. Like, there's no roof on it.
It's a tear down.
And they're like, well, I'm approved for 600,000. That's 150. So I'm going to take this 450 and I'm going to buy a house and build a house.
Yep.
And that's again back to the word mortgage, right? Just that idea that a mortgage is a product, right? But the truth is, construction lending is a whole separate thing in itself. You have to have a construction loan, and it ties a lot with the idea of buying land, right? Banks don't really love land.
Nope.
If you have a cash producing asset, as in a rented parking lot, or you have some sort of ability to make money off of it. But unlike, I actually worked with lots of investors, and most investors do not see land as an asset, they see it as a liability. Until it has a property on it and it has a certificate of occupancy, it's literally upside down. Even when it's a building with big, huge, beautiful windows and everything, before they get that certificate of occupancy, they are spending money that they are not recuperating, and they're continuing on. And I think that's why construction lending sits where it really sits, which is, it's not easy to get.
Yep.
It usually takes a little more percent down. You're going to see a higher percent down, and I typically see it being done by local banks.
Yeah. My company, we can do construction loans, but it's a very niche product that I think a lender has to have a lot of experience in, and I think a realtor has to have some experience in, because, I've seen couples, I've seen people really struggle throughout the construction process. It's stressful, but yeah, you're right. You're looking at anywhere from 10 to 20% down. You're looking at purchasing the land and then, financing the construction piece into it. I find that the smaller local banks that have like a really good construction department do the best with those. We can do them, but we have to broker them out, and you lose control of the file. And I would rather have someone that knows that product inside and out. But it's a great opportunity for someone, especially if they're sitting on land. They can use the equity that is free and clear. They can use the equity in that as their down payment, so to speak. From a credit perspective, it usually works out to be the same as any type of other conventional or government financing, but you've got that additional construction piece. And I think working with a really good builder is also important with that, because that can tie up the process.
Yeah. The big thing with construction, when I'm working with people as a broker and realtor, a lot of times I talk to them like, do you have the adjustable timeline and budget? And they're like, well, what do you mean? And I'm like, well, like, the builder, he doesn't mean to be late, but if the windows don't show up for 8 weeks because China has some, supply chain issue, or, the builder's roofer guy gets sick and he can't come into work, or, you have some sort of issue where, the builder doesn't do what he said he was going to do, and he's just that great of a guy and doesn't show up to the job site sometimes, and when he gets paid on Fridays, he hangs out till Tuesday when he runs out of money.
Yep.
Hard to say with your life in those hands. The other one is the costs. There's nothing any builder or anybody can do. You go to dig a hole, you hit bedrock, now you need jackhammers, you know,
Yeah,
you build
cost
half
goes
the
up.
house and, you know, you realize that, you know, we should take down more trees or,
Cost
you
goes
know,
up.
it just continues to change. So
Yeah.
I think flexibility, a lot of construction loan products have flexibility in them.
Yeah.
I've seen overages, usually around 15%. I don't know what you see usually around.
I usually see like 10 or 15%, somewhere in that range.
You need to have good reason, you have to have documentation, you're gonna get asked questions, you know, they're not gonna love you for doing it.
Right.
But typically, you know, all the people I've ever worked with doing it, I always say to them, it's better to not utilize the entire approval amount
Right.
than it is to go back begging for more. But that's why banks don't really love the idea of construction, because they know people get into it, then they get to the end and they're only approved to this much and they spent to that much and now they need more.
Yeah.
And they're like, well, we already warned you about this, and you know, they can foreclose on a house at any given time, you know, like they don't have to give you more money. If you overspend your budget, they don't just naturally have to give you more money. It's up to you to find it from friends and family. And again, back to that certificate of occupancy, if you don't have one of those, you don't have a house. You can't even live there.
Yeah.
The town won't allow you to live there. You can't just finish it yourself. You can't do any of the things that people might think. So it's really important to remember when playing with those ones that you really want to be honest with yourself about budget and timeline. And again, lots of buyers buy. If you buy from a big tract builder, you buy from a builder who's already built the property, you get new construction. I'm sure you've done tons of loans on new construction. It's just, you know, you're buying a finished product. And there are builders out there that you can meet that will sell you, like I've done, I just recently did one of these where we bought the land together, they identified it, we said yes, and the builder built it, and then at the end they closed the loan. The builder just...
Yeah, we're just coming in with an end loan.
Right, and the builder was just looking to make some money. He made money on a few things. He made money on the land purchase because he financed it. He made money on the house build because he did it, and he made money at the end. So everybody was happy, made it happen, made a client be able to have a brand new home. So I do see a lot of that. We've done quite a few new home purchases, and remember, you can use any of the other ones like conventional, FHA, for a new home construction.
Yeah,
as long as it's a finished product.
I've done a few of those over the past year and a half, and you're right, the delays. I mean, one of them was delayed a year from closing, and they were going to close, I think, the weekend before last year's big, I think it was, I don't even know what time frame, September, October, huge hurricane that hit Florida. And my customer wasn't going to close until after that, you know, hurricane hit. And the builder had already delayed it for a year just because they still had supply chain issues. But yeah, there's a lot of stress with it, but it's a great new construction end loans. Those are great programs. The one thing I will mention with those is you definitely need to work with a lender that is a good extended rate lock program. My guy locked in at 4.5% back in, I'll call it 2021, and he didn't close until 2022.
Yeah.
And we had like a 360-day rate lock on it. So he was able to close before rates, you know, when rates were already at 6 and 7%. So I think that's important with construction loans.
And that can be a scary one too. We talked about inflated costs. What about inflated interest at the end if you don't have that?
Yeah.
And you go through it. There's nothing that the builder did to you.
Yeah,
It's
absolutely.
nothing the bank did to you. It's the market. So.
And you might not even qualify now. So.
You know, and you know the next one we're going to talk about real quick here is hard money. So hard money, just in general, is the idea of someone lending you money, not an institution, but I can't say not an institution. There are companies that do hard money lending and things, but for a specific amount of time, for a specific interest, and it's due on that day. And if you don't get the money on that day, then you're going to be paying huge fees and penalties and things like that. See it very common with flippers.
Yep.
We see it very common with investor type property, but you know, with hard money lending, great option for those investors who want to buy more than their credit will allow, want to do crazy behaviors as far as the way the bank sees it, but you know, make big gains. The longer you do it, the better your interest rate, but usually honest numbers, 12, 15% even for your first loans. They can drop down. Like I doubt you're going to get an 8 right now because that's prevailing rate anyhow.
Yeah.
So you're going to be probably even talking higher. I mean, there's no way to lock in a hard money rate because I'm just throwing numbers out there. It's really up to the individual because they're just lending their own money and they can choose what they want, but it's typically higher than market quite significantly because the risk is there. Risk versus reward. One of the things though that I like that was discussed by one of my favorite investors was the idea of when you're using some of the different lending like hard money, people get confused because they say 12%, and it's like, well, it's not over 30 years. You're not borrowing, the money's
No,
up for
not
like
at all. Yeah.
6 months, 12 months. And
Yeah.
you owe all that 12% on
That's the term
that
that
amount
I've
of
seen.
time, yeah.
Yeah, you hit it right on the head with the rate. One of my customers had to go hard money, and she got 12%. I think she was putting down 20% on an investment property. She couldn't qualify for any type of regular financing, and she had to pay 3 points to get that. So 3% of the loan amount, and I think it was for a 12-month term. So she's got to refinance that within a year. So
And there's no choice at that point if you don't.
I mean, they do, because it's a smaller company, they do have some flexibility to extend it, but
Yeah,
if
that
you're gonna-
flexibility comes with money. Flexibility.
Big money.
Flex my pockets and I'll flex the
Yeah,
terms.
absolutely.
Yeah, and with all that, you just always got to remember that with the hard money, you're not borrowing it forever. You got to make sure, and that's back to that good contractor. If you're gonna flip and you're not flipping yourself, making sure you've got somebody that if they say they need 6 months to do the project, I don't think if I was you, I would do a 6-month hard money lend.
Yeah.
I think I would want to see probably 9, at least.
Yeah.
You know,
9 to 12
because
for
if
sure.
anything happens, it isn't their skin on the line, it's your skin on the line. So remembering that one is very important. And let's pop real quick over to chat.
Actually, on the hard money, I just had a good conversation with a great hard money lender, and what he told me was they look for what is the end game. How do you get out of this loan? And they want to have a plan in place to get you out of that loan so they don't have to extend you. They're willing to work with you on it, but again, at a higher price. But I think any good hard money lender is going to work with someone not to jam them into something, but figure out how to get them out of it.
Yeah, whenever you're going for, seller finance, construction loans, the hard money lending, or any of the other out-of-the-box lending styles, you need to think like a bank. You need to underwrite the project.
Right.
You need to show them that I'm going to borrow $300,000 to buy the property, $172,000 to buy the supplies, $30,000 for labor, and I'm going to sell it for $750. And they're like, okay, there's clear margin, there's clear wins.
We see what you're
If we
looking
have
for.
differences, plus or minus 10% or whatever, you're not just losing. Sometimes people, they get carried away because they worked for their whole life and they think, okay, well, I can make 30 grand in 6 months. And I usually make 60K a year. Well, 30 grand in 6 months is actually nothing in the world of investing in real estate, because one little swing and you're an upside down project
You're wiped out.
that's wiped out.
Yeah.
And that's why I think a lot of times it's funny, but in real estate, a lot of people get confused. Like, they're like, someone made $150,000 building my house, and they're like, well, they did have $750,000 at risk of total loss if it didn't work out correctly. And if the swing of things went wrong, 150 can melt, and it doesn't seem like it. But carrying it for another 12 months, having to have different, okay, it doesn't sell, now you need to heat the property, you have all sorts of issues. So
It's all risk reward.
yeah, definitely. And let's just touch a teeny tiny bit on chattel. Chattel, it's a fun word to say, but it's really just personal property.
Right.
And this one has become more common locally because of the unaffordability.
Yes.
There's a place at Oak Point in Middleborough, beautiful place. It's pretty badass. If you're an older person, it's 55 plus. They've got like 72 activities a week. They got a pool hall. They've got a pool. They've got aerobics, and it's a great place. But it's a 99-year lease, so you don't own the property. So you own your mobile unit, which makes it called chattel because it's personal property. So if you were to get foreclosed on by the bank, they can't come and just take a little piece of Oak Point. They come and take the physical building away and they haul it away.
So the 99 lease is on the land.
The 99-year
Right.
lease is on the land. So you don't own anything other than that trailer. So on chattel loans, what you're going to find is a higher down payment, because when they take it back, there is so little value and so much investment. Like, to take a thing off the foundation and haul it away, they're not going to want to do that typically. They're going to want to do a foreclosure sale. They're not going to want to take it. But technically speaking, it is their property. They can take it depending on the agreement with the park, things like that. But with chattel loans, just remember, you need to look at who's the best person to go through for each park. The parks typically know their favorite lenders.
Yeah.
And it's pretty easy. I know I've looked over at some places and they're very strict, other places not so strict. But when you talk with the park, they're going to point you in the direction of their favorite lenders.
Yeah.
And it's not uncommon in mobile to go seller finance, and even though they're not wealthy. Because in order to get maximum value, because think about this, right? If I was to say Oak Point, almost $400,000, $500,000 now, right? So 20% down is $80,000, $100,000. How many buyers did you disqualify? If you could afford to do seller finance and allow them the normal 5% down, you charge them a market rate 8%. You've got all this money coming in. You go move on your way. If you can afford it, it's actually
If you can carry it, right?
it's
Sure.
an actual great way as an older person to have cash producing income
Supplemental.
assets. You
Yeah.
know, so channel definitely an interesting topic. Not super common in southeastern Massachusetts because we just don't have a lot of parks left. But like I said, I get more questions about it this year than I ever have, and I think it's because to find an
It's
affordable
affordability,
place,
right,
you know,
yeah.
and be honest with you guys, a lot of the double wides, they're actually pretty cool. I don't know if you've been in, but typically you walk in, very large living room, open frame to the kitchen, front to back, and then to the right and left you have your 2 bedrooms, and they're both master suites, walk-in closets, full like 14 by 16 bedroom, a bathroom that's like 8 by 12. You're like, this place is palatial compared to my house.
Yeah,
Like I don't
exactly,
even have a
right.
walk-in closet, and they have it, but it's like a front to back, which I like the separation of bedrooms. As adults, it's nice to not be sleeping wall to wall with someone else. It's nice to have that separation, your own space. Someone's on that side, someone's on that side. So they are pretty cool. Chattel loans, you can check those out. But let's jump back one more time real quick before we end this episode and talk a little more about seller financing. And you know, one of the things I wanted to point out on seller financing, because it was actually when we talked hard money lending, it made me think about it. So with seller financing, land is a huge place seller financing exists. As a builder or as someone thinking about building, you can often get the land seller to finance the land for the entire build.
Wow,
So
I didn't realize that.
they oftentimes will finance you the land, and that'll give you a better option to get the project done. With that, you know, one of the creative people that I've met, he's like, you know, it sounds like a lot, but when you offer a seller 12% interest, they don't think about the fact that it's only over 12 months.
Yeah.
They think like, wow, 30-year loan, 12%, that's an enormous number. So by hitting those seller, you can say like, okay, you're building a house, you're gonna do no balloon payments, so you ask them for 30 years with 0% the first year and then 12% every year thereafter. Well, you're gonna be done. You're 12 months, 18 months. You
Right.
actually never pay them interest. You guaranteed them interest through the loan, but you also guaranteed no balloon payment. So they look at 30 years, 12%, and say, wow, I'm gonna make a fortune, but you actually just paid them exactly what you said you were gonna pay them at the thing. And then sometimes even seller financing, it's not uncommon to do like a 6 month. So I'll
Okay.
do a payment up front, I'll do
Yep.
a balloon on 6 and a balloon on 6, you know? So there's lots of different ways to work with it. It's really great for stuff that you may not be able to qualify for, you may not be able to buy right away. But, you know, like we said, it's all about being creative really, right?
Yeah, and so a question on that, after that, you know, let's say it is a 12-month period, they can finance out of it or flip it and sell it, and there's,
Yeah, so
do you
say-
usually see some type of penalty?
Say you're buying land, building houses, right? Like you buy the land and you're gonna build a house and you're gonna sell it for a profit. You use the seller financing, you tell them they give you whatever, so they give you 5 years, 10 years, 20 years, 30 years, doesn't matter what they gave you, you put in the terms that there's no prepayment penalty.
Right,
So when you sell that house and you get your 700,000, in the order of how the money actually pans out at that closing,
yeah,
that gets closed out and the deed transfers over, and you technically speaking actually really never owned the land because you never you have the seller
Right.
financing, so you do have title in some ways, you do have possession, but there is ways too. Like I mean, I've seen some guys that actually don't even really own the property until the first shovel hits the ground. Like using seller financing, leaving it contingent upon receiving all permits and everything, going all the way through town hall. Now your seller financing first payment starts after you're done with town hall. You know, one of the guys like Jerome Maldonado, he always calls it trash can money.
yeah.
Trash can money is that money that you're paying while you're trying to get your permits, while you're trying to get everything in order. He's like, the less amount of days I can own that property before I can put the shovel in the dirt, the less trash can money I have. Because in building and trying to make profit, whether it be a flip or anything, days cost money.
Oh,
Days cost big
okay.
money. Days cost interest, days cost heat, days cost time. Because time is money anyways. Because if you can take your money out of your investment and put it back in through
Right.
exponential growth factors, you're reinvesting. If you got your money tied up, it's going nowhere for you at that time.
Sure. what do you see as like, from a buyer's perspective doing that? What do you see as like the experience that's needed or education that's needed, like for someone who doesn't have very little to no experience in something like that?
I'd say if you want to play in it, you really want to find your favorites out there. And you know, I've worked for people, I know people that sell courses on things, and you know, I've heard of ones anywhere between say $1,000 up to like $100,000 or more dollars to have a personal coach. Guys, if you're going out and building a house and you're trying to make $150,000 to spend $10,000 or $15,000 to have someone guide you through your first couple or your first one,
Yeah.
it's like it's funny the decisions people make. You know, like, oh well, that's 10% of the whole money. Well, 10% of the whole money if you make money.
Yeah, exactly.
If you had 100% loss, it's not 90% of the money left. It's 100% loss. So my suggestion always is surround yourself with people that understand it. Get involved in the communities that are out there, the internet. I mean, you guys are watching YouTube. I can tell you the type that educate yourself. You're out there checking out. You're involved in real facts and real estate. You're paying attention to the different things going on in the market. So involvement, but also don't let yourself hesitate yourself, because that's the worst thing you can possibly do. Because one of the benefits of seller finance and creative finance on that level is that you need no money, no credit score, no nothing. So only thing holding you back is excuses.
Right.
And you can actually implement this all over the world, really. It's not like it fits in one thing. It can happen anywhere. Always make sure to check local laws. Always make sure to check state laws, because there are laws. You know, you can't just lend anyone money for any reason without having certain terms be there. So definitely check on those things, because you do have to be careful. You don't want to get, you know, the more wealthy you get too, and you stop playing with lending people money and borrowing people's money on projects, you really want to make sure everyone's clear understanding that's involved with you. When we do these projects, we can lose everything, because you know, there's nothing worse than a sore loser in an investor world that sues everybody when it doesn't go well, because the same guy who is going to be very happy eating hors d'oeuvres and, you know, caviar with you is the person suing you because it doesn't go the way they see it. So really try to focus on, you know, getting your investors profit. Put your investors even before yourself, and as far as if you can't pay your investors, you can't pay anybody. And really have the mentality of, I'm going to go out there and I'm going to win, and I'm going to do anything it takes to win. And I'm not going to use excuses, because in the world of real estate, in the world of high dollars, there is no rules per se, and there is no care. It's business. You know, and I always say to people, half jokingly, half real, they get involved in real estate, and I'm training them at the beginning. I say, listen, turn on like murder mystery show, and someone killed someone over $5,000. So when you think like an agent acting weird about a $27,000 commission and not answering your phone call back so they can get both sides is suspicious, you're right. It is suspicious. It's $27,000. So don't be the shady person, because the quick money doesn't last. Karma's a bitch, all that stuff.
Oh yeah.
But work well, respect everybody, and really just put your best foot forward out there. And guys, I really appreciate all you listening today and joining us. It's been a great episode. I really appreciate you coming in, Ron.
Yeah, thanks for having me. It was interesting.
It's great to have another person that really understands finance and to just really understand things. Why don't you throw your phone number in there in case anyone wants to reach out to you?
Yeah, if anyone wants to reach me, text, phone call, 508-294-3372. I'm always available, so yeah, reach out.
Awesome. Well, I appreciate everyone, and again, thanks for joining us this week, and we will talk to you coming up.
We appreciate it.
Have a good day.